One of the most common questions I get asked in a real estate closing is, what is PMI and why am I paying it? I'm Tiffany Weber. I'm a real estate lawyer in Mooresville, North Carolina, and I like to make videos just like this one, educating you about the ins and outs of real estate law and real estate closings. First things first, let's define PMI. So commonly people call it PMI, not knowing what it actually stands for, which is private mortgage insurance. And private mortgage insurance is an insurance policy that protects your lender in the event you stop making your payments. Now, this insurance does not help you at all if you stop making your payments. You will still be subject to foreclosure or impacts to your credit report in a negative way if you are late or you fall behind or you just stop paying altogether. In a conventional loan, you will generally be required to pay PMI if your down payment is less than 20% of what the home appraises for. For example, if you are under contract to buy a house for $100,000, let's assume that it appraises for $100,000. If you put down less than $20,000, your lender will require you to pay PMI, and that becomes part of your monthly payment. And if you want to know exactly what portion of your payment constitutes the PMI, you can see that on your payment letter, you can see that on your closing disclosure, and then you can also see it on your monthly statement if you have already closed. Usually your lender will give you a letter that explains when you will first be eligible to drop PMI from your payment. If you're in a closing with me, I'm going to go over that letter with you if your lender has provided it and show you the date that you can officially count on PMI being gone. Now, if you pay ahead of schedule, then you will be eligible earlier, but you're gonna have to watch that yourself so that you can petition the lender to drop PMI from your payment. Another way you can figure out when you're scheduled to have PMI dropped from your payment is to look at your original amortization schedule that's provided when you first close on the loan. In general terms, for a conventional loan, once you have paid the loan-to-value ratio down to 80% of your home's original appraised value, that's when you'll be eligible to drop PMI. So for example, let's use the $100,000 from before. Once you have paid your loan down to less than $80,000, which would be 80% loan-to-value, you'd be eligible to drop that PMI from your payment. Of course, you're going to be excited when that day comes because your payment will become lower, and that's going to save you money every month. Now, if you have a loan that's anything other than conventional, so an FHA loan, a VA loan, anything else, these rules are different. So you need to talk to your lender about PMI, how much you're gonna pay, how long you will pay it, so that you can have all the details just right for when you close. Now, PMI is not one size fits all. It's not like every borrower pays $50 a month for PMI and that's it. It depends on your loan amount. So sometimes PMI can be thousands of dollars a year. So you're really looking forward to the day when it goes away so that your payment can drop. All right, everybody, that's PMI in a nutshell. If you have more questions, let us know in the comments. You can also always ask a loan officer. They're really experts in this area. I'm Tiffany Weber. We'll see you in the next video.